Good turnaround Tuesday, everybody. How's everyone doing? Rebound in the dollar, rebound in the yen, rebound in S&Ps. Pretty binary nowadays, right? So yesterday I talked about, I thought the dollar was overdone and we could start to get some type of fib retracement of this. It's an inside day, but when you look at it internally on a 1 hour, you see how we gapped down into Monday. And then there was a gap up yesterday afternoon with the close. You actually have an island bottom here. Hello, Sinatra, Glenn. A little island bottom, gap down. All these candles are left on lost. So I'm looking for a continuation. As long as we don't fill the gap, we should even hold 95.50. And there's a lot of confluence on the daily. I don't know if we could get this much out of it, but at 61.8, you have all the daily moving averages coming in there as well. I don't believe this is a long-term low in the dollar, but 95.5 or so, not a bad recovery for the week. I'm thinking after this recovery, the next move could take us down to 92. So you have to be careful here because, you come in and you look at this candle, for example, on the yen, which hasn't reversed on the week. And say, for example, you wanted to get short and have your stop above the candle because the character of the market has changed. You sell it here and you sell up to the high 60 pips away. So I actually think I would wait. I see a little 1, a little 2, a little 3, and even though it's turnaround Tuesday, we have turnarounds every 2 hours, turnaround every hour, turnaround. It's not a day anymore. We have to fractal it out, so maybe it's the second hour of the day because things have speeded up. You have to risk more, so you reduce your leverage. But when you look at the yen, it's right back to a pretty important resistance area. You had all these bottoms at the 104.5 level, right? That you would call a breakdown. Okay, right here, 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 here. So we're actually above the breakdown. So, I'm not long and I can't get short yet. So I'm doing nothing. Gold looks like it may have topped, and in fact, silver's up with gold down. First time I've seen this in many weeks, maybe even many months, and I may have missed the gold top with what's happening here on a weekly basis, but I still think that there's a shot. Here you look at 1, 2, or this is too far apart to call it a 3, but you look at the 4 hour, I still think there's a chance that we get up. Steve had a number up around 17, was it 30 or something, or 1720-ish. So maybe silver could drag gold up one more time. I don't think this is a low in the S&Ps, but perhaps we're going to make some people regret it. This doesn't look great. I mean, we're just back a little bit above the low that everyone was hoping would hold. So I'm tempted to short it here. Doesn't mean we would make a new low. Maybe we could just do this. This is a first wave, and we get a pullback that holds last night. This low was put in after the New York close. Had a nice little 2 drive. When it came here, I said, well, I'll try a 3 if we get it the next day. But of course, no, just marching on. So we'll see. Maybe we could rally back to 29.80 over the next couple days. What could be positive news would be, say, for example, and Blake has pointed this out, there are primaries tonight, and if Biden carries the day in Michigan, okay, Thanks. That the market will feel comfortable about having a moderate candidate instead of Bernie Sanders. So I just don't see anything off the gun. I've learned something that took me a long time to learn, and that is, I'd rather say I don't know than just to force something to entertain you, because we're really not in this to be entertained. We have, it's not a demo account, and we're not playing poker with our buddies. So it's uncomfortable to say when you don't see a trade that you feel comfortable risk reward wise, but I don't. So I'm sorry if I bore you, but I'd rather bore you than mislead you. Cool. So I know when I feel like this, all I have to do is be patient, and eventually something will come to me. The markets will come to me, and I'll see something and I'll do it. So like Tom Petty says, the waiting is the hardest part. Get used to waiting and don't worry about it, especially with all the return of volatility to the markets. There's going to be multiple opportunities. There's always another bus around the corner. Take the pressure off. In this environment, you're going to miss trades. You're going to miss 20 trades a day. And that's okay, because there's another one coming. So, that's the advantage of being with ForexAnalytix, is because we have a team. Okay. So say, for example, let's look at best website on the net, the best welcoming voice on the net. So say, for example, I didn't know what I was going to do. We have, Grega and Andre and Blake and Steve and Stell, between all of these guys, there's always something. Even with all this volatility, you could. This is kind of interesting to me. So, the team is also being careful about risk. Again, otherwise, I've seen a lot more pattern and plays here than two. So, we want to, again, the whole team, with all this action going on.
Hey, Dale.
Yeah,
Hey, I'm sorry. I hate to interrupt you.
No, it's okay, man.
White
I know
House
you
just
got to go.
announced that the White House announced that they're not ready to roll out economic proposals. So that's why the market's coming under pressure.
Okay. No payroll tax cut.
No,
That's
sorry,
what they were talking about.
Closing some trades here. Sorry, dude.
Okay, that's all right, man.
Wow.
Yeah, Leanne came off 50 and S&Ps came off 30. I can't believe that, the market thinks the payroll tax cut is going to, energize things anyway. So
yeah, sorry, man. I'm just
that's all right.
closing out.
So there was a good turnaround Tuesday play.
Yeah, I just took some profits in the dollar yen. I was short, so I'm going to short it again on rallies now. So,
what did you see up there, Blake? Was it this?
here I'm out of everything. So let me.
All right, go ahead.
And,
all right.
So where are we? Okay.
So the Predator is finding a lot of game out here with this volatility.
Yeah. Can you guys see my screen?
Yeah.
Okay. So if speaking of which, I'm gonna just kind of parlay what Dale was talking about. So I put in a pattern in play. When the dollar yen was trading at 107 or 104.
Nice trade, man.
80, 70 something. I shorted it twice. I shorted this morning at 105.03 and covered at 104 in the chat room, guys. By the way, here you guys can, here's the chat room, just so you guys can see the chat room. So Benedict said that was quick. I thought you were looking for 100. I am, but that doesn't, here's the one thing that I want to say. I was telling one of our new listeners or new people in the chat room, look, my pattern in play is more directional. It's more of a, like, this is my bias. I am, while the dollar yen trades below 105, basically, you can see it right here. While it and sorry guys, I'll bring you back here in a second. While the dollar yen trades below 105, I'm expecting a move to 100. But and I'll put the chat room back up here. Dang it. Sorry. But that doesn't mean that I'll trade in and out of those positions quite a bit. I was telling Roch. I want to say Rach because I know a Rachel, a good friend of ours, and but RACH. Anyways, I told Rock that my patterns in play are great for bias. I can see the dollar yen and I'll trade in and out of this thing. I traded in and out of it twice. I sold it at 105.03, covered it at 104.68, sold it again at 104.78, closed it just now at 104.29. My bias, and if you guys want to see where all of those trades are here, just you can in the chat room, and I was explaining it right here. It's like I was explaining what the patterns in play and how I approach them.
Get
I
in
sold
that
half
chat
size
room.
at 78, adding at 105 earlier this morning. Out dollar yen for 36 because I shorted it. Move my stops to break even. Sold a little dollar yen at 105.03. So what you'll see, and then I covered it, wherever it was down, stop to break even. I'm just giving you guys examples of what happens in the chat room at 4 o'clock in the morning. Out dollar yen for 36. So you can see, and I'm sorry, you guys can say hi to the webinar if you want now. I'll let you guys chat a little bit. But I buy and sell based on my bias. So my bias for the dollar yen is short while we're below 105.50. Now, Simon says you can even search. Yeah, sorry, Simon, you're so much more savvy in the chat room than I am, and which is awesome. Simon's in the UK. Anyway, I'm gonna put this back up here so I can talk a little bit about
Simon says.
Simon says that's right. So the reason why I'm shorting the dollar yen, just so you're all clear, we had a false breakout. I'm expecting a move down towards 100. Right? We bounced right up to the previous trend line, right? The underside of the trend line, and basically it's the 38% retracement, guys. If you guys didn't see the 38% retracement, if you do this, 38% retracement comes in at 105.25. So while we're below that 38% retracement, I'm expecting a continuation lower. So in other words, I'm expecting this over the course of the next couple of days, right? Now, I may not be short right at this very second in time, but I will be short again today. I'm going to tell you right now, I can 90% with confidence tell you that I will be shorting the dollar yen at some point today, right? However, this news that just came out, let me go, this news that I was just rattling out when Dale was on, well, it pushed the dollar yen down like 40 pips quickly, and I said, well, screw that, I'm going to take it really fast, and then I'll just short it again. So I'm obviously pretty active in the markets, meaning I buy and sell pretty actively. Just because I'm, just because I say dollar yen short here, it's targeting here, this is where I'm wrong. this is just telling you my bias. I'll be in and out of the dollar yen. I was telling Roch, I was telling Roch that I'll buy and sell the dollar yen 5-10 times, probably over the course of the next, maybe even more than that. I mean, depending on the opportunities, I'll trade multiple times. So what led me to believe that the dollar, to answer Dale's original question, what led me to believe that the dollar yen would fail up here? Well, also, if you look at the S&P, let me give you a little heads up with the S&P. The S&P, we're in breakdown territory. We've got this pennant. We rallied back to the 38% retracement and this trend line. You see the trend line right there? We rallied back to the trend line, 38% retracement. I knew we're in the resistance zone. So it's like, okay, if I think the S&P is going to roll over here, then the dollar yen is going to be a natural trade for me to be on the short side while we're below this trend line. So like this trend line right here, I do not want to see that trend line broken. If that trend line breaks to the upside, I think the dollar yen will go higher. That's plain and simple. It will, but that doesn't mean it's going to. You know, I think while we're below it, you got to just keep thinking, hey, we're probably moving lower here. And then with the confirmation from the White House saying that they're not ready to roll out, you know, the economic plan because they're probably trying to figure out how the hell they're going to pay for it. That's probably
that's the only easy thing for
yeah.
them to
I mean,
figure
yeah, it's like, okay, we're going to roll out
as they pay for everything else.
I know. I mean, how are we going to pay for this? You know, what do we don't have the tax receipts to do that. You know, where are we going to pull money from? I mean, that's where I'm sure the sticking point is this morning at some you know what I mean? So anyway, so Dale, I know that was a very, very long explanation of why, you know, I was selling the dollar yen up there, but I hope that made sense to you guys. And for those of you that are listening in, Gregorio says, yeah, and we closed the gap. Yeah, and yeah, we closed the gap. I mean, it's pretty close, you know. But and let's talk about that for a second, because that's a great comment. Is this gap closed? There are two schools of thought about closing gaps. Closing gap would be from the closing price, which we haven't closed, right? Or from price, meaning that we've been there, we closed it. And yeah, that was another, and I'm glad that you brought that up, because that was another factor into my ideas of why I'm, you know, going to stay on the short side of the dollar yen. So yeah, that was, and it's great that you pointed that out, because I totally spaced mentioning that on top of everything else that I was talking about. So Glenn says this is not a chat room. That's correct. The Forex, what you guys are listening to right now is just a webinar. You guys, it's not paid for. It's free. This is not a chat room that you guys are in where it's just us chatting. When you're in a chat room like this is when you guys are engaged in chatting back and forth with myself, and you know, there's Stelios right there, and you know, and everybody. And Benedict says he's on the Jumbotron. You are. Will you marry me? That's Talisa. Don't get all excited, guys. Oh, shit. Oh, I've been married for almost 20 years. Never mind. Okay, so anyway, that's all I really wanted to say about all that. So now the question is what to do here. You know, as far as like, you know, for me, for the dollar yen, now I'm a little bit torn, because I don't know if we're gonna reach back above 105. I think anybody that's looking, you know, thinking about 105, the level we were at in, you know, at the end of the European trade, when I first got up at 3 this morning, 3:30 this morning, my time, which is, you know, 6:30 a.m. Eastern. I think anybody who was selling up there is like probably thinking we're not going to see that again, not today. So, and I'm thinking that too. So what I'm hoping with the dollar yen is we get a little spike back up towards 104.80, and then I can sell it. That's what I'm hoping for. Now, what I hope for and what we get may be two totally different things, because I like to always wish for things in the market, but I can guarantee you this, it just doesn't happen. I hope and pray for a lot of things in the market, and God obviously doesn't listen to me all that much. So I'm hoping and praying that we get back to 104.80, 105, and we may. And if we do, then I'm a seller. And if we don't, then I'm gonna have to find a place where, like this, I'm looking at the dollar yen right now. Like this is a pretty key support. And I think if we break back below like this 103.60, 103.70, I'm going to have to actually chase it, on the short side. I'll have to do one of these where we break down, and then I'm going to have to sell rallies. This would be my point of entry, somewhere up there. That's what I'm going to have to do if we don't get a rally from, or if we don't get a rally from current levels, which I'm kind of thinking we're not. But that doesn't mean this is the right place for me to be short. I think we're in no man's land right here. So I'm selling rallies, or I'm going to be chasing it to the short side later on tonight in Asia, probably. That's my thought. But the point that I'm trying to make here is that I have a bearish bias in the US dollar Japanese yen based on what you see in this pattern in play. I am bearish the dollar yen. So now I'm only targeting it to the short side. I am not looking to play it to the long side unless something changes, and things change. And that's the great thing about being a trader, and you're in a very fast moving market, is that, things happen. I mean, we could be sitting here, and then all of a sudden, vaccine has been approved by the FDA for immediate release of the coronavirus. The dollar yen will be trading at 110 by probably tomorrow. You know what I mean? That's when things change. I mean, you got to have some specific news that drives the market to a point where that the trend has changed. But for right now, my thought is, and this is really, this is the overall arching theme to why I'm still bearish, equities, and I'm still bearish the dollar yen at these levels, is because I don't think our administration is doing enough. I don't think our administration is taking the proper steps in ensuring the safety of the American people at this point in time. And I think that is going to weigh on
Confidence.
sentiment. And it's not, guys, and I don't think it's, don't say, oh, well, Blake, you're just you're making political, comments here. No, because look, we're not testing enough. We haven't closed down borders. We haven't shut down, things. And whether you guys can believe whatever you want. You can say, well, it's all a hoax. It's just the flu. Look, people are dying, and it's pretty infectious. And, so like I said, I actually do feel that it might be a little overblown, but the market feels, because it's not just me that says this is, I talk to my office all day. They talk to traders at banks, sitting on desks globally. These guys are the guys that I work with, the small, very elite team that I work with. Those guys are all ex-bank traders of years. I mean, 15, 20, 30, 35, 40 years. They all have a network of people they talk to, and they're always on the phone talking to this desk, that desk, these people, those people, and everybody's got the same attitude. It's like, hey, this administration is just not doing enough, and that's kind of scaring us. And so, that's my reasoning for being where I'm at right now. And like I said, you guys can believe whatever you want. It's not, that's not for me to tell you. what to do, but it shapes my bias in how I'm going to approach the market. And my bias isn't always right. And I never will tell you that my bias is always right, but my bias is what keeps me trading in the direction that I trade. And like I said, my biases can be wrong, but in this case, I know why I'm being on the short side of the dollar yen. I know why I'm being on the short side of the S&P, or, knowing why that I'm trading the dollar yen based on what I see in the S&P. One of the things, and I'm going to pass it over to you guys here in just 1 second. One of the other things that that it does concern me a little bit with the dollar yen is the bond market. The bond market, I do feel, is very frothy. It rallied quite a bit. I actually shorted the bond market yesterday. I shorted the 10-year, which I don't do often, but I shorted the 10-year, made some money, actually made some pretty good money, shorting bonds yesterday, because I know where we're at technically, and I think this is a bit of a blowout move. So what my fear is that bonds continue to trade lower, yields continue to go up, and that might be somewhat supportive of the dollar yen. But that's what makes the dollar yen a little trickier at this stage in the game, if that made sense to you guys. All right.
Everything you said made sense today, Blake, but I have to push back on one thing when you were saying, I may pray for the end to do this, but God doesn't listen to me much. Well, then you're the luckiest guy I know in America, because he certainly has blessed you with a very nice life. So maybe he does listen to you.
Hey, I'll tell you, whatever you guys decide to, what your beliefs are, I sit at my desk probably 12 to 15 hours a day, and it doesn't come with like what I have or what I've achieved, or the trading that I do, and how I manage my risk around trading. It comes from experience and hard work. And anybody who tells you that trading's so easy, it's not. And I mean, I put in the hours, guys. I do. But that's not the whole enchilada. That's not the whole recipe, but that it does help. I was going to say one other thing. Regarding the market is one of the things that I ask myself, I've been asking myself a lot recently, and it's not, do we have data today, by the way, guys? I'm sorry. It's so funny. I've kind of like even dismissed the data that we've got because it's so irrelevant at this moment.
Nothing really worth mentioning.
No, nothing. Okay. So let me tell you this before I pass it over to Steve and Stelios, and obviously Dale too. I'll
drop the pen.
What I ask myself, Dale, is because the market is so volatile, before I get into a trade, and this has been really like the last 2 weeks that we've seen this massive amount of volatility, or last 3 weeks, I ask myself, what's my edge right now? That's before I get into any trade. Obviously the first question I always ask myself is, what's my risk? So like, let's say, here's the euro dollar. I'm just going to give you an example. The euro dollar stalling at the 38% retracement. If I got long right now, I know my risk is below, 133.30 basically. If I bought it right now, which I'm not. I'm just saying if I did. First question I always ask, where's my risk? Second question is, where's my edge? And if I don't have an edge, then that usually makes me pull my finger off of the mouse, because in this very
give us an example of edge when you feel you have an edge.
Oh, well, when I feel like I have an edge is the dollar yen, when it was trading up here at 105.
Was the edge?
Yeah, it was like, okay, we hit previous support, current resistance, close the gap.
Mm-hmm.
Whether you agree with that or not. We're near the 38% retracement. I knew the S&P was at resistance, so I had this huge confluence of reasons to be on the short side at that price.
Got it.
And now that we're down here in the 30s, all I'm thinking is, where is my edge? Because now I think we're in the middle of this range. So my edge is not right now being on the short side. My edge would be closer to here, or down here. So it's my edge really represents more of my God, the equity markets look like poopy. This is where all the people that were long last night are now getting out. But
Kitty.
Yeah, that was
yeah,
my
well, you know, the people that bought
That's Steve's edge.
you know, the people that bought last night that you know, which by the way, this was a great trade. FX Macro from my office, he was like, I'm getting long spoos here because, you know, we had a CDC press conference at the end of the day, and they basically said, hey, it's really the elderly that are at risk, and he's like, I'm getting long. And that was like the greatest trade because we made a false breakdown. And once you made a false breakdown right here, right, you made that false breakdown below the lows, you know, got long, and that was a great trade. Now, this is all the people that got in last night, or, you know, in Asia or in Europe, they're getting out now, or they're in process of getting out. So again, you know, for me, I'm always asking, you know, where's my edge? You know, where's my risk? And the markets are moving so fast, guys, that you have to ask those two questions really quickly. One of the last things I want to leave with you is, let me just talk about ForexAnalytix. You know, like I mentioned, you guys, I trade for a firm. The reason why I built ForexAnalytix a few years ago, and I asked Steve and Stelios to come along as partners, and this is we're going on 4 years now, is because I knew I was leaving where I was at, coming to this new firm, and I wanted a safe place, a landing place for our traders to be at, because I've been chatting in my old chat room with so many of the traders that I chat with now, that I wanted a safe place for them to go, and in process build something that is inexpensive, that any of you guys can afford, and be involved in our community and have a safe place to go, a place where you can, you know, be in a chat room. And, you know, we have a lot of rules in here. You don't have to worry about religious talk. You know, there's some political talk every once in a while, but we try to, you know, keep it at a very minimum. You know, one comment, you know, 2 comments, that's when I start going, all right, let's calm it down. But, you know, we don't really talk about politics. We don't talk about religion. We just talk about trades. There's no selling of products. It's just, you know, hey, this is what I'm looking at. This is what I'm thinking. And then sometimes we goof around when the markets are really slow. But that's the whole reason why I built ForexAnalytix with my partners. And I've been fortunate enough to have a team like you talk about Dale or Joe and Polly and Amanda, and, you know, we got and you know, Velu, and, you know, we got a lot of people on the team now, which is great because now ForexAnalytix is more self-sustaining, and that's why, you know, I hope you guys eventually, if not today, you know, eventually you guys become part of our community, because it's really, that's what it is. It's a community. The product itself, the technology you get for the price is great, because you got a mobile app, you got, you know, this desktop, you know, platform that, you know, shoots you out, you know, alerts when, you know, there's a new analysis or support and resistance levels are breached, and it's got all these different tools that you might need, you know, whether it's a, you know, calculator for risk, streaming news, all sorts of fun stuff, and, you know, obviously the analysis to go with it, but more importantly, it's the community. So anyway, I hope you guys eventually join in, but I got to go because I got to get to the market. So Steve, Stelios, it's all yours.
Hey, Blake.
All right.
Thank you, mate.
Hey, good morning,
Good
guys.
morning.
And you guys take care today. Be careful out there. It's obviously pretty volatile. So still.
Did.
So, see you guys.
Bye-bye, mate.
Thanks, guys.
So, excuse me. So
Hey, Stel.
the main event remains obviously the virus, how things are going. And I have to say, I think, and I've been saying this in the chat room, we're chatting with some friends as well, I'm firmly in sell the rip mode, sell the bounce mode in equities and in risk assets in general. I think this is far from over. I've said this every day on this webinar for a few weeks now. Unfortunately, you're seeing numbers rising, Italy, Spain. There was a big rise in Spain today. The US, I don't even want to think about what's going to happen in the US, because I mean, obviously I'm not there, but from what I hear and read, the amount of preparation has been very low. And people have not been tested at all. You know, it's just a mess everywhere.
If you're not testing, it's not a problem, right?
Yeah, if you don't test, you don't report. Yeah, but still, you know, and I'm seeing what's happening here as well in Greece. You know, where I think the schools are about to close. We're personally taking our kids from school as of today and staying at home.
Germany's Altmaier asked if economy is facing a recession in first half.
Yeah.
Says that the situation is very difficult.
Yes. Yeah.
You know, Boris
Yeah.
Johnson's doing the same thing in the UK, guys. Just like let it pass through the population, and you know, that's it.
Well, that's
I
one
don't
of my
think anything's happening in the UK either.
Yeah, and Altmaier actually said as well. Now that you mentioned that there's going to be a kind of like a state package to help the situation worth several billion. I mean, I read that headline and I was thought, you know, I need at least another zero there to.
Yeah, several billion. It's not going to move the needle no matter what, right?
So it's my opinion. Unfortunately, things will get worse before they get better. And let's again not think that much. Although it's bad to hear that people are dying, but overall, as the population and humanity, this will come and go. But the problem is, what are the effects? What are the effects going to be on the world economy? And I think they're going to be here for months, and it's going to be difficult for the global economy, which, by the way, was already on the downside. You know, that was the bad thing. If we
That's
were,
what people forget.
Yeah, exactly.
The economy, the economy was, the global economy was slowing during the past 15 months. I mean, you know, the data were, you know, quite consistent showing that. And that all, despite the fact, as we've said many, many times, that the vast majority of economies had ended up accumulating a lot more debt annually to sustain a fraction of the growth. So in essence, even though theoretically the global economy remained, the vast majority of countries remained in the phase of expansion, that was in big extent artificial, supported by expanding deficits and monetary policy during the past years. So
yeah, you know, Steve, I tweeted that it's very serious to be exposed and become infected by corona, but it's as significant what it is exposing. And what it's exposing is financial engineering is a train wreck waiting to happen, that's beginning to happen. So it's exposing that the emperor has no clothes.
No clothes, yeah. Absolutely. And, you know, it was inevitable. We had said that multiple times. It was inevitable that, and, you know, we kept repeating, there is no way of knowing what would be the trigger event to actually do what you just said, expose the real problems. But, you know, we now know what that trigger event was. And the question you have to ask yourself is the shock to the economy big enough to push through all the resistance from the forces we just, you know, talked about, or not? And in my opinion, it very likely is. And knowing, because it's very important where you begin deflating from. And, you know, I think consensus to everybody that, you know, has an objective eye is that things were extremely inflated. Valuations were historically very, very high. Depends on what kind of measure you wanted to use. You could make an argument that it was like the biggest bubble we ever had, or the second or the third. But in any case, it was just about arguing, you know, how big of a bubble we had in many markets. So, you know, the higher you go, you know, the higher you can fall from. And I think that it's probably a bad thesis thinking that this can all go away because there's going to be some fiscal response and even further monetary policy, because I think it's not going to be enough.
Yeah, I agree. Actually, I had a conversation with a friend of mine earlier today, and he said, you know, what do you think long term? I said, look, I think we're going quite a bit lower, but in terms of equities, I mean, but if you think about what's going to happen in the next few months, we're going to get huge amounts of more accommodation easing and zero rates, negative rates, QE. They're going to be buying everything. So eventually, when all this blows over, you're going to have all this extra liquidity in the system, which means just by inflation alone that assets have to go up. So eventually, if you ask me where equity is going to be 10, 15 years from now, I think almost 100% they're going to be higher, much higher than here. But
the big question here is just in nominal values.
yeah,
Because,
obviously, yeah, in nominal
yeah,
values, yeah, of course.
yeah,
but,
because that's
yeah,
that's a big
yeah,
issue there.
yeah. But I'm just saying, I think when things do seem that they're settling and we know the extent of the damage and to the economies, and etc., I think for me personally, it's going to be time to get quite long. But we are far away from that point at the moment.
Long like Donkey Kong, yeah,
Long
but
like
we're far
King
away.
Kong, yeah.
Yeah,
Exactly.
but we're far away from that. I totally agree. And Stelio, almost every market I look at, from those that are quite tightly correlated with risk, is telling me more or less the same thing. Blake already mentioned that USD yen today back-tested this multi-year broken trendline resistance support, now acted as resistance, and so far it's failing. But that's not the only market, because let's have a look at shorter time frames. So S&P on a 4-hour, that so far looks to me like a corrective formation that is about to fail. Nasdaq, more or less, depends on how we're going to end up drawing this. We might have broken down. I want to see a little bit more price action. That might be telling us the same thing. Let's take currencies and those that are most tightly correlated with risk. This is the Aussie yen. I think that, so far, what we've seen here, and I'm saying so far because I've made the argument multiple times that you need to be a little bit careful with corrective moves, because corrective moves are notorious in fooling you sometimes, because they might begin slowly and then evolve in something different, or they might begin by showing quite a lot of strength, producing some kind of a sharp move, and then proving that that was just a spike higher. Then you get some consolidation and then you fail. But so far, because we can only judge by the price action we have so far, this is the Aussie yen. Didn't even manage so far to close the gap. The gap is up almost at 70. We are already seeing RSI divergence, and clearly, thus far this is a choppy overlapping move. So I think this is a likely continuation from here lower. If you look at the Kiwi yen, it's exactly the same type of pattern. We're currently testing support, RSI divergence on the 4-hour chart. Here again, same situation. I mean, we did gap lower and we haven't managed to close that gap, which is almost up at 67. So this one is looking bearish, in my eyes. Here is the 4-hour chart on USD yen. Huge RSI divergence here on the 4-hour chart. I mean, previous reading was like at 82, 83. This one didn't even make it to 70, and we seem to be failing. So basically, I know that a lot of people are looking like a likely scenario being some kind of a sustained move higher from here. I'm not saying that it's unlikely to see several days of a rebound at some point, and it's not impossible that we've already seen the low for several days, but until proven otherwise, especially given the fact that we got rejected from important levels. If you look at the daily, I already showed USD yen, but look at the S&P. S&P tested these lows here and seems to be failing. I would have to say that even in the short term, it isn't unlikely that there is more pain to come before we see a more sustained recovery. So I wouldn't be surprised. Let's go on the 4-hour chart in the S&P. I wouldn't be surprised if from here we see a lower low and then we get some type of a bigger reversal higher before lower again, because I do believe that, so in, bottom line, my two scenarios here is scenario number one, this one, scenario number two, we continue higher from here. So we build some other type of formation, which is too early to say what it's going to be, perhaps like a big channel or whatever. But in any case, common factor between the two scenarios is that in any case, I do believe that there's more downside to follow. So
There's
I'm
a
going
lot
to be
of important stuff at 2,600, Steve. I like that line there. I
I
have
totally agree.
monthly moving averages, and I mean, so much stuff. 26 looks pretty key to me.
Here it is. So if we go to the daily chart and we zoom out, here is 2,600, support, 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 resistance for a little period of time, resistance back there. So yeah, 2,600 is definitely an area of interest. Another area of interest I have here is 2545, 2480, 2400, 2330. So, several areas of support to begin with. Absolutely. Now, as I said, we might see a rebound unfolding, even further, even from current levels. But I wouldn't be surprised if there is a lower low before we see a big recovery. And yes, I do believe that no matter what kind of a recovery we see, we haven't seen the low. We wouldn't have seen the low. I think there's going to be more pain to come simply because the economic repercussions of what's happening here won't go away just because they're going to announce some measures, some relief measures that, will do have some influence in how the market works, but in my opinion,
payroll tax cut doesn't help if you lose your job.
100%. I'm 100% with you. And if there is no business, you're going to fire employees even if they cost less, right?
Yeah.
As simple as that. So I also believe that that's not going to be sufficient. That's not going to be sufficient. So that's my main case scenario, what I just showed. Now, having to do with metals, for example, let's go for crude first. First of all, crude is responding to the multi-year low that we did see back in 2016, right? So it almost made it to that support area, and it's responding from there. Now, how far can it rebound from here? In my opinion, it's not going to be easy going above 37 to 37.50. So 37 to 37.50 is quite a strong area of resistance. So I would be expecting something like this for crude. So as you see, the vast majority of the markets more or less give me, the same type of impression that, we might see, even if we see, this recovery lasting for a few more days, I don't think there is any reason to believe that if there's not more downside coming. And, this also applies to crude as a market. Dollar, let's have a look at the dollar. Let's first have a look at Euro USD. So Euro USD has made a clean break above this channel that dates back to summer 2018. So it's like almost a 2-year-old channel. We did produce a clean break above it. And I think that worst case scenario, even if we pull back all the way to 111.50 and retest the broken channels trend line resistance as support, that's probably going to be a great buying opportunity. DXY. If you have a look at the DXY, here it is. So the DXY has broken below this multi-year ascending channel. I think that even if we see a rebound from here, backtesting this channel currently passing at 97 is probably going to produce more dollar weakness. So, no matter how, which market I look at, it more or less tells me the same story. And, I'm not inclined to change what I believe, even if we see you know, a rebound that looks quite impulsive and sharp. I remind you, I know that many of you haven't really seen a bear market because it dates back 11 years. Or I mean, you weren't actively trading when we had, like, you know, a big bear market. Bear market rallies can be quite vicious. So, and, you know, very frequently they're gonna trap people that are looking to buy the dip because they've been conditioned to act in this type of manner. They've been conditioned to believe that in a prolonged bull market, every pullback is a buying opportunity. And, you know, there's no way you can lose money by doing that. And these are the people that do great for 4 years, 5 years, 6 years, 10 years, 11 years in this occasion, which is extremely rare. And then they can end up blowing up their account within the first couple of months of a bear market, because it's not only that they're going to give back to the market the profits they had, is because they're going to try to martingale their way into going back in the type of profit they had, which means they will be adding to their positions as the market moves lower. And when the markets don't recover, these are the people that are actually going to blow up their accounts. So it doesn't need a lot of brains to be constantly bullish in a bull market. But if you don't have the brains to understand when the market dynamic is changing, you know, you might find yourself being at, you know, on top of the horse for 10 years, and then within 2 months you're out of the business. As simple as that. And it's very unfortunate, because I see people on Twitter that supposedly, you know, have a lot of experience in the markets, and they don't seem to realize that, you know, the current environment, nothing is written in stone. Okay, is there a chance that globally we're going to escape a recession and the markets can recover to all-time highs, like, you know, rather soon? Yes, there is a chance. Is that a high chance, a high probability scenario? In my opinion, no. With, you know, with what we currently have in hand, given the fact that this is one of the most prolonged expansions based mostly on easy monetary policy and fiscal irresponsibility, neither of which can take you, you know, too far. I think that the chances are very, very low that we're not headed into a recession. And obviously, when you have a market that was priced in for perfection, there is no way that you can go in a recession and the market rallying to new highs from already absurd valuations just because there is a lot of support from monetary policy. Anyhow, let me go through some of your questions. Gold is too weak, though. I mean, gold goes same as Euro USD. Whoa, dollar is climbing. Yeah. So a lot of you have correctly noticed that, you know, despite all the jitters and, you know, the expectations for even, you know, further easing, etc., gold doesn't seem to be doing that well. And, you know, I'm going to be the last one that's going to disagree here. There is a clear loss of momentum in gold. We did test 1700. We went, you know, just above it actually intraday, and, you know, we seem to be very weak. So yeah, I mean, I have to agree with that. From a risk reward perspective, expecting some type of weakness here in gold in the short term absolutely makes sense. But I'm going to remind you my exact words when we had that massive down day here, which, you know, that day began at, like, we opened at 1643, and at some point during that day we were down at 1550. So if you remember, I was very clear saying that, yeah, okay, you know, it seems that, you know, gold is under pressure, but this is a market that, although I'm seeing the signs that you can actually get, you know, a big corrective move lower, I don't want to be in the wrong side of that market, because being in the wrong side of that market can blow up in your face, because next day you might wake up there might be some type of, event or piece of news, and that market rallying 50, 60, 70, $80 within the day. And, that proved to be the case, because like a couple of days after I was saying that, the market opened at 1580 and it closed at 1640.
Steve,
So,
I was thinking, what might be a better way to express a little short-term bearishness in gold is yesterday we were talking about the gold-silver ratio.
yeah, I'm going to make a joke here. The best
go
way
ahead.
to express that bearishness is in gold is shorting silver.
No,
Because
I think there's no, but also I think there's also maybe something happening in the gold-silver ratio here too, with today's.
speaking of which, look at silver.
Yeah.
I mean, why would you want to be short gold when silver is performing that much worse, right? I mean, in the short term, there doesn't seem to be any reason to do so. And I know, and I do agree 100% that the gold silver ratio being almost at all-time highs is overblown, and at some point in the not so distant future, we're going to be looking at the gold silver ratio and admitting that was, a magnificent long-term shorting opportunity. I don't think we're there yet, because silver
What's the
is
chart
still
look like? Yeah.
Oh, the chart is almost parabolic. I mean, let me show you. Here it is. So gold silver ratio, here's the long-term chart.
Yeah.
And we actually touched 100. We made it yesterday to 100.2.
Yeah.
We're currently a little bit lower at 97.50. So yeah, I'm with you. I think that silver is going to close that gap. I want to see more evidence to call it up.
Looks like we have two spikes, Steve. Look, when you I'd like to see one more. If you put up the 4 hour, that shows pretty good there. See the first drive, and now we've had two. We're getting a pullback. I'd go for the third one up there.
Might be the case.
Yeah,
might be the case. We might make it to the 161.8% extension at 102.10.
That could be the trade of 2020.
Yeah, I'm sure that silver within this decade is going to be trading at some point a lot higher than it currently is. At some point, silver was at 50, and I believe that was not the first and last time in history that silver is going to be at $50.
It's been there twice.
Yeah, you're absolutely right about it.
So what's missing? It's got to do it at least 3 times, right?
What I think is going to be the big trigger, dollar collapsing. That's what I believe is going to be the main trigger for the next time.
Or the stagflation, the market, the Fed, all the Fed's work finally starts working maybe sometime late this year. And, we get that.
I think the only thing that central banks are going to end up succeeding in is getting what they are saying that they want, but they really hope they don't, because they don't have any means to fight it. I mean, they do have the means, but they would then have to make a choice between fighting. If they do get inflation, they would have to make a choice between fighting inflation and tanking the economy, or ignoring inflation. So they don't want to get in front of that dilemma.
Yeah.
We have a friend here that says that he bought copper. Gautam actually says he bought copper. I understand why you did it. I said yesterday that look, copper is doing quite nicely in comparison to anything else risk correlated, right?
Fade Gotham at your own peril.
Yeah, and copper
good.
is producing some decent rebound from here, from a very, very important horizontal support. You can see dating back to 2015, we've tested that area multiple times, and it's proven its value as a supply demand zone, support resistance zone. You can call it whatever you want. So yeah, nice entry here in copper, and if you get lucky, and we've started like we are the second scenario, so we've started like a bigger recovery, having seen the low yesterday, you might be able to squeeze some nice profit out of this trade, Gautam. Hi, Steve. What is your view on USD yen testing the high again for the sell? As I said, we've back tested the broken multi-year triangles trend line support as resistance, and so far it held. So as long as we're below 105.30, I have absolutely no reason to be bullish. As simple as that. So below 105.30, I think it's it's a given that you can only be looking lower. Now, if you don't believe in that, you can be neutral as well, because that's also a position, right? Instead of losing money, if you believe that being short is going to lose you money, you can be out of the market. But below 105.30, I really don't think there is any real technical argument for being long USD yen. Now, we break back above 105.30, then I will think that this rebound can extend further. How much further? I think towards 108, perhaps even 109. So above 105.30, I think we might see another 250, 300, 350 pips of upside, while indices might be recovering towards like even 3,100. That wouldn't surprise me. Needless to say, if for some reason, and I'm using the S&P as a benchmark, because the S&P is anyhow the benchmark of risk, any type of move back towards like 3,100, personally, I'm gonna, look at it as a, how do you call it in the US? Gift horse.
Yeah. Gift.
As a gift horse. And personally, I'm taking that. I'm going to be shorting at these levels, no questions asked. As simple as that.
Okay, we've been
Coach,
here.
Do we have? Oh, yeah. Okay, so you already covered that.
Yeah.
Okay.
Yeah.
Okay, enjoy the interview, and
okay,
see you in the chat room.
All right, buddy. Thank you, Steve. Everyone thanks Steve for his hard work and getting everyone clear on what his views are. So Ben Maldonado is with us. Ben alerted me to this top, and his line in the sand at 3,200 was spot on. Hi, Ben.
Good morning, Dale.
Hey, welcome back, buddy.
It's good to be back.
So, I want to acknowledge that you did let me know when we were up around that after peaking around 33.90 and whatever, and we started heading down. You said 0.9 was in, and also while we were still heading up, your last interview, you had a 3,200 line in the sand. Yeah.
Why don't we guide him to share the screen first? Yeah.
Yeah, Ben, do you remember how to share the screen? You go to the green box.
I think I'm sharing it right now. Am I not?
No.
No, not yet. We don't have anything coming through.
Let me see. I tried to.
Green box, and then the
green box, and then you're going to get an extra screen asking you. Yeah. Now something's coming through. Yep. Now we can see.
Okay.
We can see your. Is that your Twitter?
Yes.
Okay. Yeah. Good.
And we see the whole universe every time you do it. So tell us, tell us what you're seeing in the cosmos here, buddy. And you went to Wharton. Was President Trump one of your classmates?
No, but he did come speak to us one time as I was an undergraduate, and it was an interesting thing. I do have to give him credit. He had a great line. This kid stood up, this kind of cocky kid stood up, during the question and answer, and he asked Trump, Trump had finished his speech and everyone was all excited. And he asked Trump, he said, Mr. Trump, he wasn't president then, so it was Mr. Trump. He said, we have a lot of prestigious alums that give a lot of money to the school. And, I just want to know what you're planning on doing to match that or to be a part of that. And the guy and Trump, the whole place kind of was like, oh, and, started laughing. And Trump says, what's your name, son? And I can't remember his name, but let's say he said, Dan. He goes, I'll tell you what, Dan, I'll match you dollar for dollar.
Yeah.
Dan
was broke.
That's, of course, he's a college student.
Yeah. All right. So, that is a good one.
Yeah.
Yeah, he knew. Yeah. Well, that qualifies him to be president. Good line.
Right.
So anyway, you are here. So let's talk about what you're seeing here. And I forgot the analog to Corona was what, AIDS, Ben? In that time frame, or what was it?
No, you know, I was checking that there was no real pandemic type of thing in the 70s, so I didn't get any connections there.
Okay. All right.
But what we're seeing here, and I'll give people an overview that, you know, haven't seen this before. When the first time I was on Dale's show, we discussed this in May. I've been following this analog for about 15, 16 months, and the cycles that we are experiencing now are linked to what people went through in the 70s. And so through my cycle work and then looking sort of at the big picture view and checking to see where this lined up, the period in the 70s, and specifically the S&P from 72 to 75, played out in this way. There was this megaphone pattern where you could identify 9 different points within it, and then we made a high and we rolled over. And in looking at, you know, why are we connected, or how are we connected with that? Some of the examples that Dale and I talked about previously were President Nixon at the time was battling with the Fed. Well, Trump's battling with the Fed. Nixon declared the press was his enemy. Well, Trump has declared the press as his enemy. There was the Nifty 50 back in the 70s. And today we had FANG, where people are concentrating in a few stocks and pushing the indices. Even further, there was a president that was connected with China. Nixon was the first president to visit China. Trump is engaged with China in a different way, more of a trade war. Here's the big one that came up. Impeachment.
You know what the big one for me has been, and then I'm going to let you go, is that we were dealing with a megaphone formation that everyone was paying attention to, just like we had that you have in red on the left-hand side. Mm-hmm. And then once we had the throwover and accelerated above it, people have a short attention span and they go, oh, well, there's another formation that didn't work. But all it did was have a throwover, and then next time back inside, just like it's happening now, it was back under, I'd say, 3,100, took us back inside the megaphone. The megaphone is still valid. And
absolutely. And we'll see it on the next slide when I update, when I show you how the analog is transferring to today.
Okay.
One of the last connections was the impeachment of a president. It's happened 4 times in the history of our country. Trump and Nixon are connected.
And neither were impeached.
They were both impeached and neither was convicted.
That's it. Yeah.
Yep. Both impeached, but neither convicted, because Nixon resigned and the Senate acquitted Trump.
Right. Interesting. Yeah.
The last one that I'll tell you, which possibly could play out, is in 72, we had an election of Nixon versus George McGovern. Could we get Trump versus Sanders? It's possible. If it does, it fits perfectly. McGovern was a ultra liberal. He ended up getting killed in the general election, but the hatred of Nixon was so great that the Democratic Party went so far left and nominated someone like McGovern. It could happen again with Sanders.
Interesting.
Yep. So let's go to the current. Let's see where we are on this. As Dale said, he and I have been talking about this, and I messaged him when I thought 0.9 was in, but as you can see,
I wear bell bottoms when I interview you. Right. Go ahead, man.
You get your VW bug with your peace sign on it.
Yeah.
So we made the 0.9 high and have come down very sharply since. What I've drawn out in yellow here, and I'm not very good with the drawing tools, so it's pretty rudimentary, but it just kind of gives you an idea of the speculative path that we're looking at going forward, provided that we continue to follow this analog. Steve has laid out the case this morning. And as Steve was talking, it was like I gave him a preview of my speech, because he's hitting on a lot of the points that I'm going to discuss. What we have now, this 0.9 high came in. And I'm going to go over what I call sort of like the anatomy of a top for the next couple slides to show you how we sort of triangulated that. We're in the process of putting in this initial low. I agree. I think we make a lower low first, then get a rebound. You know, how big that rebound's going to be, we don't know. We'll have to see, you know, how things play out. But there'll be a nice healthy rebound, and then we're going to turn lower again. So the key thing here is we don't use the analog as like, oh, this is gospel, this is how it's going to go exactly. We use it to see if the cycles are helping us pinpoint sort of timing.
And they give you a bias.
That's right. It gives you a bias. It gives you a way to a speculative path to look at. And as long as price confirms, and that's the most important thing, as long as we have price confirming, you know, then you can say, okay, the analog's working. Let's follow along. The top. How did we find the top? Couple of things. So what we like to look for, and what I like to look for when we're looking at the market timing issue here is combining cycles with price action with some sort of geometry. So we get a price, a time, and then confirmation through the market through price action. This chart here is the ES monthly, and at the exact top, we ran into significant geometry at that high. So when we hit that price, we could say, okay, if we turn down from here, this is significant. We hit that price in a cycle window, as shown on the analog. We were looking for this price, this 0.9. So we hit a significant price at a significant time. That sends the alarms off, right? And now we're just looking for confirmation from price. Here's another way to look at it through the SPX. And this one is set from 1982 when the whole bull market took off. You can see way up in the right corner with the red arrow, again, significant geometry at that high. So we've got the time, we've got price, now we need price action confirmation.
Yep.
This is the ES 60-minute with the arrow on a bar where after this bar, I had another very strong piece of evidence that a top was in, something had changed, price action was giving us a strong signal. And what happened there? What was going on? All through this uptrend, we would sell off on news, we would sell off on some sort of event, whether it was the trade deal's on, the trade deal's off, we're close to this, we're close to that. This selling came out of nowhere. There was no news, there was nothing on the tape, but it was strong, big, aggressive selling. And then the rebound was tepid. There wasn't a strong snapback like we had seen on the way up. There wasn't this, aggressive buying that just, blew us right back to the spot of the decline. And so it was a strong signal in terms of price action that, hey, pay attention, something's changed. And it was in a cycle window. It was with price having achieved an important high. So all these sort of things lined up, a lot like Blake was describing this morning in his yen trade, which is, I had this resistance, I had S&Ps in this gap, we filled the gap, this, that, and the other thing. He had enough evidence that it gave him a high confidence trade. Well, here, this was sort of things lining up, price, time, price action, where we could say it's looking pretty probable, with a high probability that we've turned, that something's changed. And Dale, you mentioned it. Here's a couple tweets that I put out with the dates on them, talking about the change in price action, that the character of the market changed. Things are different. So we have to act differently. We have to think about, okay, what are your strategies going to be? What are you going to do? And this slide, I think, and Dale, you're uniquely equipped because of your experience to talk about this. When the market changes, you must adapt. You must change. The biggest thing that new traders who have never been through a bear market have to understand is what worked really well in the previous bull market is the exact thing that's going to ruin you in a bear market. And when I was trading 20 years ago,
I was adapting a little early a few times, Ben.
Yeah,
before the market changed, I was adapting.
Right,
so,
and that's,
anyway, I'm just saying that sometimes you're better off not really looking too far ahead, because I've thought this was going to happen for at least the last year. So a lot of false attempts and some blood transfusions necessary to stick to it and stay at it. But that's something else. Don't adapt to the change until the change.
That's right. Wait for the market to change. When it tells you through price action, through the tools that you use, when it tells you that things have changed, you must adapt.
Yeah, the lesson I learned over the last year is you don't have to be the first one. You don't have to be the pioneer.
No, pioneers generally end up with arrows in their back.
Yeah, yeah.
So the key thing here is, and I'm saying this for people who are new to trading. If you've never traded through a bear market and you have terrific gains from the bull market, do yourself a favor and get to cash and sit. Somebody gave me that advice in 2000 when I had never been through a bear market, and I didn't follow it. I was cocky. I said, you know what? I can do this. Look how much money I made. I know how to do this. This is not that difficult. And the job of a bear market is to take all those bull market gains away from people that don't have a real edge. All the bull market geniuses. So if you can learn by watching, by having experienced a bear market without experience the emotional and financial pain, you will be so much further ahead of the game. And it's it's not a thing that a trader wants to hear, like, oh, get to cash. But getting to cash and preserving your capital and waiting for the right moment is the best advice I could give people who have never traded through a bear market.
Return of capital rather than on capital.
Absolutely. If you can hold on to those bull market gains, that's a huge victory in a bear market. You don't have to add to your stack. Just hold on to what you made, and you'll be super far ahead. One of the things that people have talked about was, and I still hear people talking about it when this decline started, is that the Fed has your back. Don't worry. The Fed's going to be there. The Fed will take care of you. And guess what? That worked miraculously for the last 10 years, right? Any dip was bought. The Fed came in. They backstopped it. There was the Fed put, the plunge protection team, whatever people call it. The Fed did have your back. I think that tide has turned. And the next chart is going to show why I think that. Here's a list of all the emergency rate cuts the Fed has made since the early 90s. There's two that worked out really well, 94 and 98, and they were done in isolation as we were moving strongly in an uptrend. Look at the clusters where you have 3 rate cuts, 2000, 2007. And then look at where we have the first rate cut at this time. I don't think the Fed's going to have your back. If you're relying on the Fed to bail you out, I don't think it's going to work. They're probably going to cut rates again next week, so we're going to get a cluster. And they're probably going to cut rates one more time. So we're probably going to have 3 rate cuts in this environment. If history is any guide, it didn't work out well for people that bought because they thought the Fed had their back.
Yeah, that's interesting.
Yeah, it's telling because we've been trained for the last 10 years.
Yeah,
that if the Fed cuts, if the Fed comes in,
BTFD, that little cartoon that people have played for a decade now.
Absolutely. So so the question is, what do you do? How do you adapt? And you guys have done a terrific job at ForexAnalytix talking about what you need to do and ways you can change. Reduce your trade size. Sell the rips. Don't buy the dips. Buying the dips worked before, selling the rips is probably going to work now. Trade less. Trade higher time frames. So you are trading less. These are the types of things that if you're going to trade and if you're in there and you believe you have an edge, and remember, unless you are doing what is based on market truths of things like price action, Elliott wave, market structure, you don't have an edge. Right? Those are the things that'll work in a bull market, they'll work in a bear market, they work in any market. Buying the dips only works in a bull market. And this is the key thing that we have to remember. One of the things that we do daily is we put out these fuse lines that we've talked about. And I just want to quickly show a couple of those that, show something that, it's worked really well in the bull market. And I want to just show people how it's worked since the market broke and things changed on the 20th. The red thick line here is the first fuse of the day. The lighter red line is the second fuse of the day. And this is basically a line that you use to know when price is above it, you got to look for bullish setups. When price is below it, you look for bearish setups. This is the chart from the 20th on the day we got that big seller that changed the character of the market. Here we had, we got caught down below it, tried to get back up, huge sell-off. Next day later in the day we rally back up into it, can't get above it. And these aren't cherry picks. I'm just going like 3 or 4 days right after the market changed. Here's your fuse line. You know that if you get stuck below it, you need to look south. Came down, broke the trend line here. There's your sell. Same setup on the one later in the day. Got below it, broke the trend line, you get the sell. Next day. Rallied up into it, can't get above, you got to sell. Rallied up into it, can't get above, you get a sell. Later in the day, rallied up into it, get a sell. And this is, again, another tool that helps you, limit the field in the market, define where you have an edge and where you can take a trade where there is an edge on your side. And as Blake said, if you're trying to trade in here, where's your edge? If you're trading up against the line and you're trying to sell it, there's an edge.
Okay.
Last one came on the next day. Very simple. Gets below the line, tries to break above it. You can put a trend line here. You can sell it on the pullback there. You can sell it on a break here. Also, what I wanted to do was do a little review of the last time I was on.
Yeah.
The last time we spoke about some themes for 2020. Volatility was one, inflation was one, and commodities. We have a big check on volatility. Volatility's kicked in higher. Inflation, we've got none so far. And no signs of inflation in any of these inflation gauges. The one thing we can look at and say, this is still a work in progress is if all this monetary easing and fiscal stimulus trying to do is going to find its way into the real economy, it's going to create inflation. On the chart here, we have monthly beans. It's still triangulating, sort of getting itself wedged into an apex here. At some point, we're either going to have to break down or we're going to break up very strongly. My bias here is that we break up strongly, but price has to prove here. The grains, as well as other commodities, have been under pretty big pressure with this market weakness. Monthly gold. Gold hit the target that we discussed, one of the targets that we discussed from the last show, 1686. I still think we have much higher targets to look at. The monthly is pointing up to the 1775 to 1935 area, 2 different targets. I'm looking to be a buyer of gold if we get a pullback, into the 1613, 1600 area. I'm pretty bullish on gold longer term.
Okay.
Crude Crude is interesting in that it's come down right to pretty strong support from early 2016, and so far it's holding. If we can put in a higher low on a pullback, I'd be willing to trade crude on an upside try, on a shorter time frame. But I got to see it, be able to put in a higher low on a pullback. Right now, it's in a weak position, and until we see that that sort of technical information that we've got a higher low, we've got buyers coming in, and that was a good low, I don't think you can trade long crude.
Okay.
Here's the 10-year. 10 years is interesting in that the high we made yesterday was in pretty significant and important geometric resistance, which may cap this for a while. And a lot like gold, I think, we're in a period where we may see some sort of, sideways consolidation in the treasuries. The market's certainly extended. It's very bullish. As long as we remain above this geometric support resistance line, it's going to be,
like 150. I mean, that pattern would measure the breakout from there, 150.
Absolutely. If we can break out and exceed the high that we made yesterday, 150 is the target.
I'm just talking about like the, your red lines, like a neckline right there where it came out, and just the magnitude of the formation arithmetically would take it there.
Absolutely. And
that
up here
line holds.
Up here we have the geometric support resistance, so it's in that 150 area. And these circles are interesting in that, in the ways in which we use them are kind of unique, is that it's not so much to say, oh, the price is going here or the price is going there, but it's to define the timing of the move. So as long as we're inside this circle, the move that's occurring can continue to go. When price breaks out of the circle, you generally see some sort of retrace or potentially reversal. So there's time left here. If we go back to gold, that's crude. You can see what happened here when we broke out of the circle on crude, right? We're following the circle nicely, getting a nice up. We break out of the circle, and there's your reversal and your weakness.
That's interesting.
Yeah. And then gold, here's gold. So gold, again, we've got time, because this is a monthly, so we've got time to make continued moves higher and continue to follow the arc of this move. So it's a very, in summary, we're in a volatile time. I think you need to have an edge to be trading. You're not going to get away with the mistakes you got away with in the bull market, and having these fundamental truths that are backing you, mainly being price action, support resistance, market structure, and geometry. Those are the types of things that are going to guide you through this.
Great presentation, Ben. You want to show the attendees and people to watch a video how they can find you?
Yeah, sure. Let me get back to that.
Okay.
You can find me on Twitter there.
Okay. At Benji Maldonado.
That's right.
You want to show your website?
I don't have it up right now, but
okay,
it's no worries.
Okay. All right. Well, Ben, thank you so much for updating us. Keep up the great work. Really enjoy having you like a regular in face and, contributing to our sessions. And I hope that you and your family are safe and healthy, and that the circles that you draw are filled up with happiness for you and everyone you work with.
I appreciate that, Dale. Same with you. Stay safe and be careful out there.
All right, man. That's a wrap for us today on Turnaround Tuesday with Ben Maldonado. Could find him at Benji Maldonado. And very interesting work. Those circles are certainly something that I don't see many people work with Ben. So nice original work, and you're my trading warrior brother till the end of the bear market and the beginning of the new bull market in 2045.
Absolutely.
All right, partner. So that's
Thanks,
it,
Dale.
everyone. You're welcome. And remember, don't just count your pips, count your blessings, and reduce leverage. And the only thing that I do a little differently, Ben, to trade larger time frames. If you want to trade, I even saw Steve Volge had a 15-minute chart up. Steve Volge, a 15-minute chart. So narrow your time frames so that you can narrow your risk and just be opportunistic. Very difficult to be a position trader in this environment. If you can do it, congratulations to you. But the kind of ranges we've been used to, you could capture them with shorter term time frames and not have to risk 200 pips on a trade. So we'll see everyone tomorrow. See you in the chat room. Adios. Thanks again, Ben.
All right, Dale.